Hey guys, welcome back to the channel. In this video, we're breaking down stocks versus bonds versus cash. What actually happens to your money? Made simple enough that anyone can follow. Let's get into it. In 1928, three people each hid $100. Same money, same country, same 96 years of waiting. The first person ended up with about $2,500. The second, around $7,700. The third, over $1 million. They didn't work harder. They didn't get lucky. The only thing they did differently was where they put it. Stocks, bonds, cash. Three words you hear constantly, and almost nobody explains what actually happens to your money inside each one. So today, we fix that. Forget the charts for a second. Picture three jars on a shelf. The first jar is cash, actual money, sitting still. Notes under the mattress, coins in a tin, the balance in a basic account. The second jar is bonds. That's money you've lent out, and someone's promised to pay you back with a little thank you on top. The third jar is stocks. That's money you use to buy a tiny slice of a real business. You don't lend it. You own something. That's the whole game. Hold it, lend it, or own it. And here's the part nobody tells you at 14 or at 40. Each jar behaves completely differently when you're not looking. One of them is leaking right now, slowly, and you'd never feel it. Let's start with the jar that feels safest, cash. Cash has one magic trick. The number never goes down. Put in 100, it says 100 tomorrow. That feels like safety. But watch what happens underneath. Imagine your $100 bill is an ice cube in your pocket. The cube doesn't get smaller, but the world around it gets more expensive. Every year, the shop quietly nudges prices up. That candy bar, that bus fare, that pair of shoes. We have a name for that quiet price creep: inflation. And on average, it runs about 3% a year. So your $100 is still $100, but a year later it buys what 97 used to. You didn't spend a cent, and you got poorer anyway. Now stretch that across a lifetime. Over the long run, cash earned about 3.3% a year, and inflation ate almost all of it. Your money basically ran in place for 96 years. That's the trap. Cash isn't safe. Cash is slow melting. The number stays still while the value drips away. And because the number never drops, you never notice the puddle. And this isn't ancient history. Think about it. 30 years ago, a movie ticket cost a few dollars. A bottle of soda, pocket change. The same dollar back then could buy roughly double what it buys today. Same dollar. The number on it never changed, but the world quietly doubled the price tags around it. And lately it's been speeding up. In one recent year, prices jumped more than 4%. So the money sitting still in your account isn't resting. It's shrinking, in slow motion. Every single day you leave it there. Okay, jar number 2, bonds. This one sounds boring. It's secretly clever. Here's the whole idea. Your friend needs $10. You lend it. They write you a note. I'll pay you back in a year, plus $1 for the trouble. That note is a bond. When you buy a bond, you're the lender. And the borrower is usually a government or a big company. They take your money, use it, and pay you a steady little thank you every year, then hand your original money back at the end. That steady thank you is why people love bonds. It's predictable. It shows up like clockwork. Over the long run, bonds paid about 4.5% a year, better than cash, smoother than stocks. But bonds have one scary word: default. That's when your friend ghosts you. Can't pay, won't pay. The note becomes worthless. And this really happens. Whole countries have ghosted their lenders. Argentina has failed to pay back its bonds more than once. People who lent that government money waited years, and some never got all of it back. But flip it around. When the borrower is rock solid, like the US government, people trust it so much that its bonds become the thing everyone sprints to when they're scared. The safer the borrower, the smaller the thank you. The shakier the borrower, the bigger the bribe they have to offer just to get you to lend at all. So bonds sit right in the middle. More reward than cash, less drama than stocks. The polite, reliable friend who almost always pays you back. And now, the jar everyone calls risky. Stocks. Here's what a stock actually is. and it's simpler than they make it sound. A business needs money to grow, so it chops itself into millions of tiny slices and sells them. Buy one slice, and you own a piece of that business. A real one. Picture the lemonade stand on your street. You put in $20 to help it open. Now you own a slice. Hot summer? Line round the block? Your slice is worth more. Rainy week? Nobody buys? Your slice is worth less. That's it. When you own stock, you ride every good day and every bad day of a real company. Apple, Nike, the businesses you buy from constantly. And here's something wild. You might already own slices like this without realizing it. If anyone in your family has a pension or a retirement account, a chunk of it is almost certainly sitting in stocks. Tiny slices of hundreds of real companies, quietly working in the background. And that's why stocks feel scary. The price moves. A lot. Some years it jumps 20, 30%. Other years it falls off a cliff. In 2008, the whole stock market dropped about 37% in a single year. If you had $1,000, you watched 370 of them vanish, on paper, in 12 months. But here's the part that doesn't make the headlines. If you didn't panic and sell, if you just left it alone, your money clawed all the way back within about 5 years. The people who lost forever were the ones who jumped off the roller coaster at the bottom. The ones who stayed on rode it back up the mountain. So why would anyone choose this jar? Because of what happens when you zoom out. Over the long run, stocks returned about 10% a year. Not because every year was good, most years were a fight, but because you owned things that grew. You didn't hold money. You didn't lend it. You owned the engine. So if stocks win over time, why does anyone keep money in the other two jars? Good question. Here's the catch. That roller coaster needs time, years, sometimes a whole decade to work its magic. But life doesn't always give you a decade. If you need the money next month, rent, an emergency, a car that just died, you can't risk it being stuck in the middle of a 37% drop. That's what cash is actually for. Not growing. Waiting. Ready, safe, and boring. Exactly when you need it fast. And bonds? They're the in-between jar, for money you'll need in a few years, not decades. So it was never really stocks versus bonds versus cash. It's the right jar, for the right job, at the right time. So let's line the three jars up. Same starting money, 96 years. What actually happened? Remember our three people from 1928? Here are the real numbers. The cash person, the one who felt safest, turned $100 into about $2,500. The bonds person, steady, reliable, ended with around $7,700, 3 times more. And the stocks person, the one everyone called reckless, about $1.15 million. Same $100, same century. The gap isn't double. It's not 10 times. It's hundreds of times. Here's the mental picture to keep forever. Cash is standing still on a melting floor. Bonds are a calm escalator, slow, smooth, always up. Stocks are a roller coaster that over decades climbs a mountain, but screams the whole way up. Now the part that makes you dangerous in a good way. Let's use the real words. That price creep on cash? Inflation. Your gain after inflation? That's your real return. And for cash, it's brutally close to zero. The steady thank you on a bond? That's the yield. The thing that decides everything about stocks over time. Your time horizon. How long you can leave it alone. And here's the one grown-up nuance most beginners miss. People say just split your money between stocks and bonds. When one drops, the other saves you. That's called diversification, and usually it works. In 2008, stocks crashed, but safe bonds went up and cushioned the fall. Usually. But in 2022, something rare happened. Stocks fell about 19%, and bonds had their worst year in modern history, falling too. Both jars dropped at once. That's the real lesson hiding under all of this. There is no jar with zero risk. Cash risks inflation, bonds risk default and bad years. Stocks risk the roller coaster. The question was never which one is safe. It's which risk am I choosing and for how long. So what actually happens to your money? Cash melts quietly. Bonds drip steadily. Stocks swing wildly. And given enough time, climb. 3 jars. Hold it, lend it, or own it. Now you can actually see inside each one. Quick, honest note. This is not financial advice. It's how the machinery works. What you do with it is yours. But we deliberately left the advanced jars closed. How you actually mix these into a portfolio, what an index fund is and why it might be the simplest stock slice of all, and the real mechanics of interest rates, the hidden lever that moves every one of these 3 jars at once. That's part 2. If you want it, comment jar 2 and I'll make it. Subscribe and I'll see you in the next. And that's a wrap. If this made things click for you, do me a favor. Hit subscribe and share it with someone who needs it. See you in the next one.